Good evening, everyone, and welcome to tonight's hybrid event. Get into financial ready, what you need to know, plus the federal budget update. And thank you for joining us online and also in person. We're delighted to have you join us this evening for this engaging session, specially designed for doctors and medical practitioners. We have an excellent speaker tonight from our platinum partner, Cutcher Neale, who will take us through the presentation, and I'll be introducing them a little later. My name is Kathy Ball, and I'm the membership lead at AMA Queensland. Firstly, I'd like to do an acknowledgement to the country. We acknowledge the traditional custodians of the land on which we work and live. We pay our respects to elders past, present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. Just a few housekeeping notes for tonight. The presentation will run for about an hour with plenty of time for questions at the end. We have muted our online guests during the presentation. So if you do have any questions, please post it within the chat. And for our in-person guests, we can do the question time at the end of the session. As a part of AMA's partnership with our platinum partner, Cutcher Neale, members do receive a 1 hour free consultation with them. So if we don't get to everything tonight, we do encourage you to take advantage of that offer. Before we get to the presentation, I'd also like to mention a great incentive for our members. AMA Queensland does offer a referral program where you will receive a 25% discount on your membership for the following year if you refer a colleague who successfully joins AMA Queensland. For full terms and conditions, please go to our website. And what we have now is a few events that are upcoming. We do have our members networking event up on the Sunshine Coast. That is on Thursday, the 28th of May. We do have some still tickets available for that. So please, RSVP does close tomorrow at 12 p.m. and members do get a free ticket plus they do get one ticket per member. Following this, we do have on the 29th of May, the Sunshine Coast Roadshow for GPs and non-specialists. RSVP tomorrow as well at 12 p.m. 2 tickets per member for that event. And our much loved dinner for the profession will be held this year at Blackbird in Brisbane on Friday, the 5th of June. Make sure you RSVP for that because it will close on Monday at 10 a.m. for that. We also are heading up to Cairns this year, and we do have on Thursday, the 18th of June, we have our Cairns member networking event. There's 2 tickets per member for that one. The following day, on the Friday the 19th. Friday the 19th. Sorry, I've written it on. Friday the 19th, we do have our Women in Medicine breakfast up in Cairns, and there is 2 tickets per member for. Oh, sorry. The Sunshine Coast, sorry. That's okay. And then we do, followed by that, we do have our Sunshine Coast Roadshow where there's 2 tickets for each member for that one. And also on Saturday the 25th and Sunday the 26th of July, we do have our Junior Doctors Conference. This year we're going to Mackay. There's still sponsored tickets available to that, thanks to our platinum sponsors. And this year, for our international annual conference, it will be held in Copenhagen in Denmark. And that will be from Sunday the 20th to Saturday the 26th of May. There's a few rooms left. Please see the website for the brochure, and you will get 16 CPD hours for that event. And the last event I'll mention tonight is our much loved Women in Medicine breakfast in Brisbane. This will be the theme. It is art of juggling, and we hope you can join us for 2 For all information about our events, please visit our website at www.amaq.com.au. Now, on to tonight's hybrid webinar event to get into financial ready, what you need to know, plus the federal budget updates. Our guest speaker tonight from Cutcher Neale is Cole Brown. So onto the webinar, we'll go on to skip the last minute to end of financial scramble and head into the year with confidence. Our tax time tips will ensure you are organised early, making smarter financial decisions and setting yourself up for a strong finish to the financial year. Your future self will thank you when you start the next with a plan in place. In this section, we will cover the 2026 budget updates that affect medical practitioners, professionals and practices, the key end of financial tax planning strategies to optimise your financial outcomes, learn how to maximise your deductions, how to identify common end of financial year pitfalls to avoid last minute stresses, and create a proactive financial plan for the next financial year to improve your cash flow. And please join me in welcoming Cole from Cutcher Neale.
Thanks for the introduction, Kathy. And I'm lucky I've got Brendan here from our team here in Brisbane, who's going to present on some of the negative gearing from the federal budget and talk us through some of those end of financial year strategies. So last Tuesday was a pretty big night in terms of the budget night, and I've been in this industry for quite some time and never had a budget like it. So yeah, it'd be interesting to talk through that, and then any questions and so on, please do throw them my way at the end. I mentioned Brendan and myself, we're based here in our Brizzy office. We service clients all around Australia, spend most of our time servicing clients, so here within Queensland and on the East Coast. But always good to get away and out of the office with AMA Queensland at the Cairns and Mackay, I think it is this year, and Sunshine Coast next week, so looking forward to it. Cutcher Neale's been around since 1953. I actually relocated from our Newcastle head office about 5 years ago now. I've never looked back. I really enjoyed my time as a Queenslander, and yeah, really love it here. So we really enjoy the work that we do with our medical professional clients, and you know, we love the role we play in education, as well as helping guide our clients in relation to their specific scenarios and so on. There's lots of things that we do. The only thing we don't do is legal work, but pretty much anything else, we like to think that we can help you along the way. So definitely, like Kathy mentioned, we've got the hour, complimentary consultation, and we're always happy to just have a discussion with any AMA Queensland members as well, just to run anything past us. To you might feel like you're on the right track, but if you just want to question it, then definitely reach out. We've got our contact details at the end. So we mentioned, first up, we're going to cover off on the 2026 federal budget announcements. Then we'll skip into the end of financial year tax planning. We have reduced the content in relation to the end of financial year planning just because we wanted to take a bit more time to cover off on the federal budget. But again, reach out if you do want a bit more detail. We'll finish with some top tips and then questions and answers. I guess before we jump into the budget, at the heart of everything we do, we're always conscious of there's some changes that look likely to occur in the taxation space, but you've got to be conscious of how that interacts with your circumstances from an asset protection point of view. So we know as medical professionals, there's indemnity insurance that you hold to provide that layer of cover, but we're always trying to ensure that we're structuring affairs for our medical professionals to keep it as safe as possible, all of those assets that you build up. So that's where you go, well, is tax my priority or asset protection? And everyone will have a bit of a different opinion on that. So important that we don't forget that. You got to know your structure. If you're feeling like you're not all over what your structure looks like and so on. Definitely get some more information on that as you're working through some of these budget measures. I've got here top 15 budget measures, but the main ones that we're going to focus on are the capital gains tax discount and some changes coming into effect, the impact of discretionary trust being taxed at a minimum 30%. Negative gearing is a big one, impacting our whole client base and what that could look like. And then some small business depreciation, which really, I guess, assists anyone that's carrying on a business activity through an ABN as a doctor, or maybe you've got a service entity or, you know, running some other alternative business. There were quite a lot of other things that, you know, obviously came about in the budget that you would have heard to do with, you know, national reforms, modernising private health, strengthening Medicare, driving kids. Okay, there we go. And this is recorded, that's right, isn't it? And shared with all registered attendees and so on. So you'll get the detail too. And a whole lot of other things. So I guess I'm focusing on, I'm an accountant. I'm going to cover off on the taxation aspects that I know best. I'm sure a lot of these other things you know more about than me. We've seen lots of headlines. It looks like a mess on the screen, but lots of headlines. This was from a day or two after. Every morning I walk the dog, I get my coffee, the paper, The Australian, is there, and the headlines are still coming through. So lots being talked about. One of the key things to keep in mind with where we're currently at is that nothing's been legislated. So all of these, they're all proposed measures, proposed changes, and you've got to be very conscious of that, because doing something too soon could end up costing you longer term. I was speaking earlier on, and there's Division 296 legislation, which I'll cover on briefly at the end, which is to do with superannuation and how member balances over 3 million and over 10 million and extra tax that's being imposed. That legislation went around in circles for about 3 years. So that's the key part to understand. Things do take time. There's a few short deadlines that we'll talk through with some of these measures. We're going to, if that's okay, we can just hold questions until the end. Capital gains tax reform is coming. So at the moment, there's a 50% capital gains tax discount if you hold the asset for more than 12 months. And it's being replaced with an inflation adjusted model with a minimum 30% tax on real gains. It's proposed it will take effect from 1 July 2027. If it's okay, we can hold questions until, yeah, that's all right, just to keep it flowing, if that's okay. And who will it affect? It affects anyone or any investor who holds shares, property, unless it's a new build, and any other longer term investments, so even an investment in a business if you're a shareholder and so on. The one thing to keep in mind is that you've got to make sure that you seek advice and you're making decisions when the legislation, or if the legislation is passed. One of the really interesting outcomes in all of this is, I say nothing's escaped it except for new builds. And the idea behind that being it's to, you know, really increase the housing supply and so on, and to motivate. I wear my accountant hat and I go, you know what, new builds get a really good depreciation deduction. So you're going, you know, what does this look like? There's limited land and all these things. They're not going to go into that, but it's kind of leaning towards if you have a willingness to invest in new builds and you're increasing that housing supply, well, we're not going to penalise you for doing that. You know, one of the big issues with this is there's lots of young people who are yet to enter into the housing market, and, you know, we've heard all the stories about it. But if they've chosen to invest in, you know, we deal with lots of junior doctors and so on, they might have chosen an alternative investment strategy thinking, well, I can't buy a house for so long, so instead I'm going to invest in shares, I'm going to invest in maybe some ETFs and so on. They then decide, okay, let's say that housing supply is unlocked. I've got to sell my shares, sell my investments, and now I've got to pay more capital gains tax. So it's a really complex one, and you kind of go like 2 steps forward and you come one step back. So let's talk through a couple of scenarios in a little bit more detail. So what if you're holding investment at the moment and you sell it prior to or by the 30th of June 2027, or you enter into a contract to sell? The key part with capital gains tax is it's based on contract date, not settlement. So if you think about a property, you sign a contract, that might be prior to 30 June 2027. If it settles, a month later, it's the contract date. Those investments are still eligible for a 50% discount on capital gains tax if you've held it for more than 12 months. So really no changes. So just important in mind, but you've got to always consider, well, if I do decide to do something, what's my alternative investment strategy then? What does that look like? The second scenario is, so capital gains tax was introduced in September 1985. Anything purchased pre-CGT has never been subject to capital gains tax. It's been brought into the picture and will be subject to capital gains tax from 1 July 2027. So it doesn't matter if it's let's say it was a medical practice that was purchased prior to 1985. Maybe it was a property that was purchased prior to 1985. Could be, shares that were purchased. Everything is being impacted as part of these capital gains tax changes. Gains on capital gains tax assets that were purchased prior to 1985, at 1 July 2027, we're going to have to get a valuation of that asset. The property, it's speaking to a real estate agent. There's desktop valuation software that we have access to. If it's listed shares, well, you know what the value is. Pretty complex when you're considering, well, what if it's shares that I hold in a medical practice or a company that carries on the business of a medical practice, units that are held in a unit trust that maybe carries on the business of a medical practice. The ATO is suggesting they're going to put out there some guidelines to do with how you determine that value. I can tell you we undertake valuations for medicos, non-medicos. There's lots of different valuation methods that can be taken into account. It'll be interesting to see what the detail tells us in all of this. I guess the key part with an asset that's been held prior to 1985 and you continue to hold it is you're paying capital gains tax on that uplift in value that happens from that valuation that's obtained at the 30th of June. Still, you're paying capital gains tax on an amount that you had thought that would never be the case. Another scenario. So what if I hold the asset on the 1st of July 2027 and sell it after this date? It gets pretty complex. The gain is split into 2 components. It's the gain that accrued from when you purchased the asset up until 1 July 2027. You still get the benefit of the 50% discount. The gain accrued from 1 July 2027 onwards is subject to the indexation, which I'll take you through as an example, and the 30% minimum tax. It's complex. That's what you've got to take out of it. So it's grandfathered up until that 1 July 2027, whatever growth has happened up to that point in time, the grandfathering being the 50% discount, but then it's the indexation on the growth beyond that. It's pretty complex to work through and to even sit here and go, well, what should I do when we don't have all of the modelling and so on as to what it's going to look like. Here's a bit of an overview as to what it could look like if you were to sell an asset. So let's say we purchased a property for $1 million and it had 7% growth, and we sold it about 10 years later for $1.967 million. Under the current rules, you would have a taxable capital gain of $483,000. If you were paying tax at the highest marginal tax rate, the tax payable would be $227,000. Under the new rules, based on the proposed indexation measures, we're running with the same $1 million. We still sell the property for the same amount to someone at arm's length arrangement. However, what happens is I've applied a 3% indexation to the $1 million to get to this for this scenario, but we end up paying tax on $623,000. It's the difference between what I sell it for and the uplift that I get in relation to what I paid for the property. So we're paying 47% tax on $623,000, which means we're paying $292,000. So $65,000 more tax under the new measures. So a substantial impact, and keep in mind it's a minimum 30%. So even if you weren't paying tax at 47%, it's a minimum 30%. I guess the key takeaway is not to panic. With doing something too fast could prove costly. It costs a lot of money to get. If you're talking about property, it costs a lot of money to get into property. There's stamp duty, it costs a lot of money to get it out. There's agent fees, legal fees, and so on. So I'd say if your initial investment strategy, we're going to lock in and hold this investment property for a longer period of time, all these shares and so on, don't change that strategy yet, because in a way, all of those investments are impacted the same. So just stay pretty close to the detail, and as we get some legislation coming through, we'll be able to, give specific advice and so on. The second big one, this one here has been talked about for a very long time, and we understand like it does not impact all taxpayers because not everyone has a discretionary trust. So the alternative name for a discretionary trust is a family trust. And what does that mean? Usually a family trust has been used as an investment vehicle to keep assets out of individuals' names. Family trusts have been around for a long time. They provide a substantial amount of asset protection. And that's where I come back to what are we trying to prioritise, tax or asset protection. This 30% has been talked about through many different elections, but here we are. If you instead were investing through a company, keep in mind the minimum tax rate is 30%, and what the tax rate in an investment company is 30%. So they've just trying to get everyone to a minimum 30% tax rate.
What would bring income tax down to 30%? Sorry.
Wouldn't that be good? These ones will take it. This one's proposed to take effect from 1 July 2028, so it has been pushed out a little bit longer. And there are proposals in place to provide some rollover relief if you were looking to restructure maybe how a business is run. So we know there's lots of service entities that actually operate through a discretionary trust. It's usually not a strategy that you take unless you know for certainty that you don't want to have any other doctor invest within your practice or service entity, because you actually can't do that effectively within a discretionary trust. It needs to be like a unit, like a fixed unit trust or a hybrid trust or a company. So this is really impacting, I say, your mum and dad investors, whereby there could be investments that have built up over time within the family trust. It's an investment vehicle that they've had there because they've wanted to have a separate investment opportunity that's different to their superannuation, knowing that you've got full flexibility with the family trust. You can buy, sell, take the cash as needed and so on. And it's worked very well from a tax effective point of view if you've got adult children, so kids over the age of 18. Mum and dad are still providing financial support to them. This has worked very well because you get the benefit of their adult marginal tax rates. If they're not earning any other income, you might have found previously you're paying zero tax on distributions coming out to them. And from 1 July 2028, it's proposed it's a minimum 30%. I think I mentioned this a little bit earlier on, but if you have a taxable income of $200,000, the effective tax rate on that is 30%. When you work through the different marginal tax rates, so $200,000 equates to about a 30% tax rate. So if you've got a family trust that's got beneficiaries that are being distributed to that are earning less than that number, which is most family trusts, you will be paying more tax under the measures from 1 July 2028. To remind us all the benefits of a discretionary trust still, asset protection. It's legitimate income splitting, albeit we're paying a higher rate of tax under the new 30% measures. A family trust provides for really flexible distributions within your family group. There is an annual trust minute that needs to be documented to reflect that. And a family trust has historically been eligible for a 50% discount on capital gains. And that's why no more. So that's why a family trust has been used more so than a company historically to build up investments and so on outside of super, because within a company, there's been no capital gains tax discount. Within a trust, we've had it, but we will not have it when the measures come into effect. The only one, just out of interest, the only entity whereby the capital gains tax discount didn't change is superannuation, but that's because they've kind of already tackled that with an increase in tax based on member balances and so on. A bit of an example, you know, I've tried to simplify the example to say, well, at the moment, if you have $150,000 distribution coming out based on the beneficiary has no other income in their name, the tax that would be paid is about $39,000. If you have $150,000 coming out from 1 July 2028, we'll be paying $50,000 tax, but $10,000 more under the changes. Just to outline too, so the beneficiary will get the benefit of a tax that's paid by the trust. So at the end of the day, it's a $10,000 increase in tax for a family group. For anyone that has what we call a bucket company or a corporate beneficiary, so why do we call it a bucket? Because historically, and they continue to be used at the moment, to distribute to from a family trust and to defer tax that can be paid out at a later date, maybe into retirement and so on. Been a pretty good strategy. It does work very well. However, under the new measures, these have been tackled pretty hard. This double taxation's happening. So the scenario there is, let's say we've got $100,000 from a family trust that's being distributed to a bucket company. The trust pays $30,000 tax. Unfortunately, there's two different scenarios running around. This is the better of the two. The company gets the amount of money. The company has to pay 30% tax on the amount of the distribution. It's a 51% tax rate. The alternative, which is talks through, it gets pretty complex, is about a 61.2% tax rate, if anyone's seen that in any headlines. We know at a future point in time, there's dividends that come out of this bucket company and so on, but keep in mind, there might be some action that needs to be taken with any of these bucket companies that are sitting there within your family groups. Again, it's proposed from 1 July 2028. So we've got a couple of financial years in there. For practice owners, you know, outside of a few of the other, I say clinical or health measures that are being put out there, the one that's been talked about for quite a long time and it keeps moving every single year is, at least they've confirmed that any plant and equipment that's purchased for a practice or, you know, business activity that's been carried on will be immediately deductible per item that's purchased less than $20,000. So if you buy 5 $20,000 items, that's $100,000 immediate tax deduction in the year that asset is installed and ready for use. This here, it's been in place for quite some time. The issue's been it's never been properly legislated. They keep increasing it for a short period of time for the financial year. They pull it back to $1,000. They then come out and let us know again, no, it'll be 25,000, 30,000. Anyway, they've confirmed for any small businesses, what's a small business classified as? Business turnover less than 50 million. So captures most businesses that are carrying on an activity. Again, we always say don't go and spend $1 just to save tax. You got to make sure that it is something that's definitely needed for your business. I'm going to hand over to Brendan now, who's going to talk you through negative gearing, which no doubt is a really important one in front of mind for you, and then take you through some of the financial year measures. Thank you.
Thank you. Thank you.
Yep. Cool. Thank you.
Thanks, Nicole. I brought my notes because there's obviously a lot to talk about, in particular with negative gearing. So negative gearing, it's long been a feature of Australia's housing market. And obviously with the proposed changes, the Labor government says the goal was to rebalance the housing market. So the main reason behind that was because investors are currently competing with first home buyers, often with their tax advantages, and that's contributed to the rising house prices and lower home ownership among younger Australians. So part of the policy objectives is to encourage investment into new housing supply, not existing homes, help more people buy their first home, especially across the younger generations. So I guess the key question is what has actually changed with all the negative gearing proposed changes that the Labor government is proposing. So from 1st of July 2027, the budget proposes that negative gearing will be limited to new residential properties only. For any existing properties who already own them will be fully protected and grandfathered. New investors buying existing homes from the budget announcement, 12 of May 2026, can no longer offset losses against their salary, and losses can only be used against future rental income or capital gains. However, there is a transitional period in which existing residential properties bought between 12th of May 2026 and 1st of July 2027 can be negatively geared, but will not be able to be negatively geared from 1st of July 2027. Just something to note quickly, So something to note is any property that was held at the announcement is grandfathered, but property held is also defined as a contract that was entered into, but not necessarily settled. So here's an example of, I guess, the impact of changes for negative gearing. So you can see that there's a rental income of $45,000, less the expenses of $10,000 and the interest, which is all deducted. The net, I guess the negative gearing initially was $25,000 for those properties.
So rent goes up $500 a week.
So you can see there that I guess the net would be $25,000 across all properties. However, the tax saving for the pre-budget is around $11,750. For post-budget and already established homes, there is no tax saving. Okay, but the post-budget new build, you're looking at $11,750. So between pre-budget and post-budget for new build homes, you'll still be able to negatively gear. And the after-tax cost you can see there for the post-budget established is at $25,000. So this just touches base on a few of the points that I raised in relation to the residential properties post 1st of July 2027. However, it's important to note that excluded from that is properties that are held in superannuation funds, commercial properties, and all other asset classes. One key thing to note on that too is the new build definition. You'll notice there that it specifically says that new builds are residential properties which genuinely add to supply, but it's also to include dwellings that are constructed on vacant land or where existing properties are demolished and replaced with a greater number of dwellings. However, knockdown rebuilds or substantial renovations that don't increase the supply won't be eligible. So on top of that, a new build cannot have been previously sold unless it's first owned by the builder and not occupied for more than 12 months. So in relation to a offset account, as you're all probably aware, with an offset account, every dollar sitting in that account directly reduces the interest charged on your investment loan, while still keeping the funds fully accessible. So this is a far more flexible than making extra repayments, which can create tax and deductibility issues if you withdraw funds from personal use later. From a negative gearing perspective, this is critical. You want to maximise deductible interest on the investment loan while using your own cash in the most tax-effective way. Without an offset structure, you could unintentionally reduce your future tax deductions or pay unnecessary non-deductible interest elsewhere. both of which may erode your long-term wealth. So the next topic that I'll talk about is the benefits of tax planning. This is probably one of my favorite areas of the year to, I guess, basically work with our clients, because it allows us to work closely with our clients and also provide, I guess, the best strategies that we can to minimise tax. And it also helps us assist with the future cash flow needs and long-term goal setting that are specific to your needs. So what does tax planning involve? Well, it's industry-specific deductions. So in the medical industry, there's a lot of medical work deductions, such as your scrubs, your professional memberships and subscriptions, conferences and seminars, work-related software equipment. All of these can be claimed. I guess the key thing is, with any expense that's being deducted, it needs to be directly related to earning your assessable income. Another one to note is prepayments. If you're an SBE under the ATO Income Tax Act of Section 82, you're allowed to prepay a deduction for an expense, and that's as long as you use that within 12 months, you can use that expense and claim it that year. So these are things like, for instance, your rent. Prepay that in advance in that financial year and claim the deduction for it. Income protection insurance. This is a really good deduction that I like specifically talking about, because it's one way that you get to, I guess, provide yourself with a level of coverage against any unforeseen events that may occur, but you can actually claim a deduction for it in your tax return. Something that people may not be aware of is the waiting periods on income protection insurance. So that can vary between 30, 60 or 90 days. And you can also have a level of a cover that may be, it may be not applicable to your actual salary that has been done recently, because your income protection insurance may be older than what it was. So if you have income protection insurance that you're running at the moment, we do have our risk advisors that review income protection. So if you want to have a conversation with us, by all means, just reach out to us and we can review policy. There is a lot of superannuation strategies that can also reduce your taxable income. You'll notice here the concessional contribution cap is $30,000. Now a concessional contribution you can claim a deduction for. So that's things like salary sacrifice in your super through work, or you can make a personal contribution and then fill out a notice of intent form and claim that as a deduction later. The concessional contributions are different from your non-concessional contributions, because these are contributions that you may make into your super that you won't be claiming a deduction for. I guess one of the reasons why people may make non-concessional contributions is for things like estate planning. It can become very, very useful for that. You'll notice that the concessional contribution cap at the moment is $30,000 and the non-concessional is $120,000. From the 1st of July 2026, the concessional contribution cap is going to increase to 32.5, and the non-concessional is going to increase to 130. So there's also carry forward unused concessional contributions, and these are valid for 5 years, provided you have a total super balance less than $500,000. So what that means is if there's a contribution cap of, let's say $30,000, and you haven't used that for the prior years, you will be able to make that contribution and claim that as a deduction if you exceed your $30,000 cap. And that rule lasts for 5 years. And these can be claimed by, people who might be on parental leave, they're returning to work. You can do a one-off large deposit, and basically that helps with increasing your salary and surplus cash. So I'm going to get back to Nicole now, who's going to run through the superannuation inclusive.
Thank
So,
you.
thank
Thank
you.
you, Brendan. You're paying attention. Saw the slide pop up. So I've got there no further changes in relation to superannuation, and I'll talk you through the Division 296, which you've probably heard a bit about, but a 15% tax rate applies within superannuation if you're in, call it accumulation phase, so whilst you're still working or before you step into retirement phase. Superannuation provides asset protection, and as Brendan just mentioned, there's opportunity to maximise your tax deductible contributions. The one thing you've got to be very careful with though is the moment funds have been contributed to super, you pretty much got to accept you're never going to get them back until retirement. So proceed with caution. There's 12% super as a compulsory amount from employers. Hospital pays at 12.75% still, and quite often the doctors in Queensland Health salary sacrifice an extra 5% up to the 17.75%. From 1 July, just something to note is payday super is coming into effect. It impacts you if you're an employer, so if you're running your own rooms and so on. And for anyone who's an employee, your superannuation must be paid into your super account within 7 days of you being paid your wage. So a bit of a change. The ATO are a little bit tired of employers that still aren't paying their super in a timely manner. The software is all there to facilitate it, but it does require a change. Anyone who's earning more than $250,000, there's this Division 293 tax, so not to be confused with Division 296 that I'll talk about in a minute. It's an extra 15% tax on contributions that are made. So really your effective rate on super contributions is really 30%. Again, we're coming back to that 30% that we talked about earlier on with a few changes. You know, I'd say if you're feeling really comfortable about your personal financial position, the amount you're getting paid and so on, I'd say try not focus too much on the extra tax on super, because at least when it's in there, the earnings are being taxed at 15%. So, and you can request a release of that extra 15% tax to come from super. So at least to cash flow it. We like to think about compounding effect. So, you know, for every $100, you're reinvesting $85 if you've got a member balance less than 3 million. So it's $85 being reinvested as opposed to maybe outside of super. You know, on $100, you got $70 to reinvest if it's at the 30% rate, or maybe less if you're paying tax at 47%. Division 296 that I've mentioned a couple of times. So commencement date 1 July 2026 is proposed. The big issue initially with Division 296 was that there was going to be this taxing of unrealised gains. So as your asset values change, there was a proposal to apply tax at that point. And the biggest issue was you haven't sold the asset to actually pay the tax. So how can you possibly impose that? The key ones to keep in mind are, so members that aren't in retirement phase that have a member balance up to $3 million each. So if you think about a couple, you might have a self-managed superannuation fund or industry account. If your member balance sits below that $3 million, you will pay 15% tax on the earnings. If we have a member balance between $3 million and $10 million, we will pay an extra 15% tax on those earnings. So an effective tax rate 30% above that $3 million. For those lucky ones that are sitting on a member balance over $10 million, you're effectively paying a tax rate of 40%. So that's when you go, well, as I enter into retirement phase and so on, are there opportunities to take more out and have it invested and pay 30% company tax or something on that? So anyway, planning strategies, big picture, super's there usually until age 60 to 65, and maybe the rules will change between now and then, but at least we didn't hear much in the budget at this time. From a year-end planning perspective and thinking about the budget, just some tips there to think about. The final one is try and stay calm. Don't do anything too fast. You know, lots of meetings that have been booked in for these year-end strategies. It's then going, okay, but what if these measures come into effect? And you kind of going, okay, it's good to know what that worst case position would be. However, your investment strategy is your investment strategy. And try and stay aligned to that. So there's just details for Brendan and myself, but like I said, this is all going to get shared with you, and then I think I'm handing over to Kathy to close out. Is that right? Thank you.